In today's explainer, we're diving into a really fascinating strategy for one of tech's heavy hitters, ServiceNow. We're going to explore how you can use the market's own hesitation to your advantage. It's a pretty cool concept. So let me just kick things off with a question for you. What if you could get paid, I'm talking cold hard cash, right now, just for agreeing to buy a stock you already like? And here's the kicker. You only have to buy it if it drops to a price that you'd be absolutely thrilled with anyway. Sounds pretty good, right? Well, that's the exact idea we're unpacking today. Okay, so let's get into it. Our case study here is ServiceNow, and the ticker symbol is, fittingly, NOW. We're looking at the stock right after its Q1 2026 earnings report, which, as you know, is always a really interesting, kind of pivotal time for any company. So after some pretty big swings, ServiceNow's stock has kind of hit the brakes. It's settled into this holding pattern. It's not really dropping anymore, but it's not taking off either. It's just consolidating. And for an investor, this moment of indecision in the market, well, that can create a very specific, very interesting opportunity. This holding pattern is our cue to look a little closer at the data. You know, the market is always giving us clues, these technical signals that can help us build a smart strategy around this exact kind of price behavior. So the first big clue is this number right here, $84.60. This has acted as a super important price floor. When you look at the charts, whenever the stock has dipped to this level, buyers have just flooded in and pushed the price right back up. It's like a powerful line in the sand. And the second crucial piece of this whole puzzle, 57%. That's a measure called implied volatility. Now, you can just think of high volatility as, well, market uncertainty. The more uncertain folks are about the future price, the more expensive options contracts become. And if you're a seller of those options, hearing more expensive is music to your ears. So, okay, let's put this all together. What do we have? We've got a stock that's off its lows, but is bumping its head on some resistance. It has a really strong support level way below where it's trading now. And on top of all that, we have high volatility, which is pumping up the prices of options. This combination, it creates the absolute perfect setup for what we're about to do. And that perfect setup leads us right to our core strategy. It's a powerful tool for this exact scenario, and it's called the cash-secured put. This is how we get paid to wait. Now, I know, the name sounds super technical, right? But the idea behind it is actually incredibly simple. Think of it this way. You're essentially telling another investor, hey, I'm totally willing to buy 100 shares of ServiceNow from you, but only if the price drops to this level that I choose. And just for giving them that safety net, they pay you cash, immediately. That payment is called the premium. And when you actually do it, it's really just two simple steps. First, you sell that put option, and poof, that cash premium lands right in your account. Second, you just wait. You wait for the option's expiration date to see what happens. It's a strategy that's really built on patience. So how do we take this idea and apply it directly to ServiceNow using those signals we just found? Let's lay out the exact blueprint for this trade. Here are the nuts and bolts. We're looking at selling a put option that expires way out in January 2027. We're going to choose a strike price of $80. That's the price we're agreeing to buy the stock at. Now remember that strong support level we talked about? This $80 mark is well below it. And for making this agreement, we collect an estimated premium of $8 a share, which comes out to a nice $800 per contract. Now this is where it gets really good. This setup creates an incredible safety net. Because we collect that $8 premium upfront, our break-even price isn't actually $80, it's $72. That gives us a massive 30% cushion from where ServiceNow is trading right now. And that's exactly why the source material calls this a structurally conservative trade. This isn't about swinging for the fences. It's about setting up a high-probability trade with a huge margin of safety that's tailor-made for the current market conditions. So, what happens next? What could happen between now and that January 2027 expiration date? Well, this is the best part. This whole strategy is designed so that no matter which way the stock goes, you can end up with a really good outcome. There are basically two paths this can take. Let's break them down. Scenario 1. ServiceNow's stock price stays above $80. If that happens, the option you sold just expires worthless. And that $800 premium? It's all yours. You keep the whole thing as pure income. You literally got paid to wait. Now, scenario 2, the stock does drop below 80. In this case, you make good on your deal and you buy 100 shares, but your real price is just 72 bucks. You end up owning a fantastic company at a huge discount. And let's be really clear, buying at $72 is an extremely attractive outcome. That's a price that's below the lows the stock hit earlier this year. You're getting a company that's growing its core subscription revenue at a whopping 22% year over year. And once you own the shares, you can turn right around and start selling other options like covered calls to generate even more income. And this all boils down to one final crucial question you have to ask yourself before you ever consider a strategy like this. What's your main goal here? Is it to generate steady, consistent income from your portfolio? Or is your number one goal to own shares of ServiceNow for the long haul? The beauty of this strategy is that it can lead to both, but how you feel about those two potential outcomes, well, it all comes down to your answer to this question. So there you have it. That's how you can potentially get paid to wait on a great company like ServiceNow, all by combining what the charts are telling you with a really smart, conservative option strategy. Thanks so much for joining this explainer. If you found it valuable, please do us a favor and hit that like button and subscribe for more.